everyone! In this video, we are going to look at stages of funding. But before that, let's look at some pre-steps. Suppose you have a great idea and you want to put it in execution. You need to analyze and validate the idea in the market, create a business plan, including the budget, and then you would think about gathering funds for execution. This is where you will need to understand the stages of funding. The funding stages are bootstrapping, crowdfunding, pre-seed and seed rounds, venture capital, Series A, B, C and beyond, initial public offering, also IPO. Let's look at bootstrapping first. Bootstrapping is the first stage of funding. This stage is also called self-funding. This is your first investment to start your idea into execution. This can be from your savings, friends or family being investors. You may ask, why can't I pitch my idea and get investment from angel investors at this stage? Or, why do I have to put the money from savings initially? The reason is that investors don't want to take high risk and invest in a product at a very initial stage where there's no traction or branding established for the company. This is why in this stage you invest money from your savings or from family and friends and build a prototype. You will create a killer pitch deck and a business plan so you can pitch to the investors to move further after you build your prototype. Crowdfunding. If your idea is interesting enough to lure the common public, then you may choose to crowdfund. It means you can raise a campaign and the public will fund your startup. However, they also need something in return. The crowdfunding model works in two ways: offering equity in return, offering incentives or perks for donation. Let's look at offering equity in return. Here, you can provide a percentage of ownership in your company to these investors. In the future, if your company attains profit, you will have to share that profit with these investors. And in offering incentives or perks for donation, you can provide the investors with some gifts or free membership on your website or free subscription for a premium plan if you have a web-based product. Pre-seed funding. If you have built a prototype or have a product with paid customers, you can approach an angel investor. But before that, estimate the market value of your startup to decide the equity percentage with the investor. An angel investor can be a businessman or an owner of another startup who invests in companies in return for a stake. If you get funding at this stage, you can utilize it for further product development or market research. Along with that, an angel investor can help with the expertise that is required to develop your product. Seed funding. During this round, your product would have been launched in the market and gain active consumers. You might also have achieved long-term clients and strategic partnerships with other companies. Hence, you need funding to hire additional staff and operate on a bigger scale by selling more products in the market. Remember, at this stage, the presence of a robust management team plays an integral role in convincing angel and seed venture capitalists. You may also need to decide about the level of investors' involvement in your startup to seek their expertise for your company's benefit if that fits in your industry. Venture capitalist rounds A, B, and C. If your company is making good revenue but struggling to make profits, then you can approach venture capitalists for more funds. It has various series of funding depending on a company's requirement and its growth potential. Series A financing enables a company to develop income-generating operations and provide long-term returns for the investors. Investors will take risk in the hope of generating profits for them. So, it is important for them to get convinced that your business is going to earn profits for them, even if it is in the long run. You will need to show a track record with previous investments that a company is doing well. So, the investors are able to fund your startup under Series A round. Series B round. It is similar to Series A. The potential of your company as a revenue generating model has been proven at this stage and you would need funding to expand further in other regions. Series C would be required to take your startup to a bigger league, such as to acquire competitors, develop new products and services. Convincing investors at this round becomes easy with your previous successful track records of revenue and profit generation. In other words, Series B and C rounds are expansion rounds. Initial public offering, IPO. It is a stage when a business decides to sell its shares to the public. The opening share prices of the IPO are fixed via an investment broker who gets a target of selling some particular amount of shares at a specific price to raise money for the company. Once the company gets listed on the stock exchange, it can celebrate success to the fullest. However, some choose to get acquired by other competitors in the market and work on new ideas. Now that you know all about funding, we hope you would have better clarity while drawing your business plan.